Get back to the banks, J.P. Morgan and Wells Fargo. Let's get more reaction to those numbers. Leslie Picker joins us now. Again, rejoins us. Hi, Leslie.
Hey, Joe. Well, some merger activity should serve at least J.P. Morgan pretty well here because they did see their investment banking revenue drop during the quarter as the entirety of Wall Street, essentially. But just to kind of dig in a little bit more on Wells Fargo, as I mentioned earlier, this has been the standout performer this year, obviously trading below book, but has been, outperforming the other large banks. And you can see their shares are up more than 2% this morning. Part of the reason behind the bullishness surrounding Wells Fargo is its liquidity position, its ability to redistribute capital to shareholders. And they say in the third quarter, they increased their common stock dividend by 20%, and their CET1 ratio, which is a measure of health in the bank, was 10.3%. That's 110 basis points above their current regulatory minimum, including buffers. So capital levels, they say they'll be prepared for a wide range of scenarios, including a slowing economy and market volatility. Another key play here is Wells Fargo is much more of a pure play on the rising interest rate environment. So you can see during the quarter, net interest income was up 36% from the year ago quarter. That's largely based on higher rates, higher loan balances. Now, here's the question on NII that a lot of analysts and investors are asking is, when you can see that inflection point, have rates risen to a level that those benefits will start to taper off a little bit? And you can see deposits down there, loans are up. The provision for credit losses in the third quarter in 2022 included about $385 million increase in the allowance for credit losses, reflecting loan growth and a less favorable economic environment. So you start to see different elements of kind of this NII trend that they've enjoyed so much this year. How is that shifting as we start to reach a threshold that I think many people didn't see possible with regard to where the Fed funds rates will go? Will it be beyond 4%? And if so, how does that impact kind of the NII, the margins that these banks have enjoyed all year?
Kind of like life, Leslie. They get if it were a nice yield curve, it'd be great for them, but then you got to offset, I guess you offset the potential slowdown and credit losses with the higher rates. So it's, something wins out. But today, at least it didn't disappoint even after those big gains so far. Didn't disappoint after those big gains the sector saw yesterday.
And that tells you something, too, because obviously with the big gains we saw yesterday, I thought it would take, quite a big beat or quite a lot of, improvement in order for these stocks to rally on their earnings. But you can see they're up pretty significantly on at least top line beats for each of them. And the NII aspect of it, which they've definitely been enjoying this year, a lot of that's really been priced in. So the market is tending to react to other areas that have outperformed in addition to just some of the tailwinds that these banks have been seeing.